You're scrolling Zillow, perfect house. 3 bedrooms, good schools, $350,000. You call your agent. Sorry, they say. Sold yesterday. Cash offer, no inspection. Closed in a week. You lost to an investor. Again, here's what they don't tell you. It wasn't some landlord buying a second property. It was a Wall Street firm managing tens of thousands of homes like it's a stock portfolio. They've got $10 billion to spend. They're buying entire neighborhoods, 200 homes at a time, before they even hit the market. And in cities like Atlanta, Phoenix, Charlotte, 1 out of every 4 rental houses is now owned by a handful of massive companies you've never heard of. This isn't a conspiracy theory. This is what happened after 2008, and it's changing who gets to own a home in America. Let me show you exactly how this works. You've probably heard BlackRock is buying all the houses. That's not quite right, and the mix-up matters. BlackRock is an asset manager. They manage money for other people, pension funds, retirement accounts, ETFs. They invest in mortgage securities and some real estate funds, but they don't directly buy individual houses. Blackstone is the one you should know about. They're a private equity giant, and after the 2008 crash, they pioneered something that didn't exist before, buying single-family homes at massive scale and turning them into rental empires. The confusion? The names sound identical. But Blackstone is the firm that actually changed the game. 2008, housing market collapses. Foreclosures everywhere. Prices crater. While regular families are losing their homes, Blackstone CEO Stephen Schwarzman sees an opportunity. In a 2009 letter to shareholders, he calls distressed residential real estate one of the most attractive investments available. So in 2012, Blackstone creates Invitation Homes. The mission? Buy foreclosed single-family houses in bulk, fix them up, and rent them out. This had never been done before at this scale. Historically, single-family rentals were owned by small landlords, your neighbor with an extra property, a local investor with 5 or 10 houses. The idea of Wall Street buying thousands of homes and managing them like a corporate portfolio was brand new. By 2016, Invitation Homes owned nearly 50,000 properties. In 2017, they merged with another big player, Starwood Waypoint, adding 30,000 more. Blackstone eventually sold its stake in 2019, pocketing roughly $7 billion, more than double what they invested. They made $3.5 billion in profit and walked away. But Invitation Homes didn't disappear. It's still the largest single-family rental company in America, with over 84,000 homes. And Blackstone, they jumped back in. Blackstone now controls roughly 62,000 single-family rental homes across the U.S. Invitation Homes isn't alone. There's American Homes 4 Rent, 59,000 properties. Progress Residential, 83,000 properties. And dozens of smaller institutional players. According to the Urban Institute, large institutional investors owned about 574,000 single-family rental homes as of 2022. That's roughly 3.8% of all single-family rentals nationwide, a small slice of the overall market. But here's the thing, national averages hide what's happening locally. Institutional investors don't buy randomly. They target specific metro areas with strong job growth, population influx, and crucially, limited housing supply. Atlanta leads the pack. Institutional investors own roughly 25% of single-family rentals in metro Atlanta. That's not 3%, that's 1 in 4. Phoenix? About 20%. Charlotte? 22%. Tampa, Dallas, Jacksonville, Las Vegas all have significant institutional ownership and concentrated in certain neighborhoods. In some Atlanta zip codes, just 3 companies, Invitation Homes, American Homes 4 Rent, and Progress Residential, own 19,000 homes at the start of 2022. Think about that. 3 companies, 19,000 homes in one city. Institutional investors aren't buying mansions or fixer-uppers. They're laser-focused on a specific type of property, relatively inexpensive single-family homes built since the 1970s in growing metro areas. Why? Because that's where the returns are. These homes attract middle-class renters, families with decent incomes who want yards, good schools, and suburban neighborhoods, but can't afford or don't want to buy. Average Invitation Homes tenant? Late 30s, household income around $100,000, kids in school. The investors ignore expensive homes in wealthy areas, boomers and tech workers buy those, cities with stable or shrinking populations, no rent growth, properties needing major renovations, lower margins. What they're targeting are exactly the homes first-time buyers use to compete for. Starter homes, entry-level suburbia. And they're not just outbidding you, they have structural advantages you can't match. Here's where it gets frustrating. Institutional investors aren't just competing on price. They've got tools and advantages that make it almost impossible for regular buyers to win. Let me break down exactly how they're playing a different game. You need a mortgage. They don't. When you make an offer, it's contingent on financing, on inspection, on appraisal. The seller has to wait 30, 45 days for your loan to process, and there's always a chance it falls through. When Invitation Homes makes an offer, it's all cash, no contingencies. Close in 7 days. Put yourself in the seller's shoes. 2 offers on the table, yours for $355,000 with a mortgage, or an investor's for $350,000 cash with a guaranteed close. Who would you pick? Sellers pick certainty. Even if your offer is technically higher, they go with the institutional buyer because it's fast, clean, and zero risk. Redfin data shows investors bought about 17% of homes in Q4 2024, but over 75% of those purchases were all cash offers. You're not just competing on price, you're competing against capital you don't have. Institutional investors don't wait for homes to hit Zillow. They use data analytics to predict where neighborhoods will appreciate. They track employer relocations, school district ratings, public transit projects, population growth. They're running algorithms on thousands of properties simultaneously, identifying targets months before regular buyers even know to look. In some cases, they cut deals directly with home builders. In 2021, an investment firm bought an entire brand new neighborhood in Conroe, Texas, 124 houses, straight from the developer before a single unit went on the market. Invitation Homes has partnerships with home builders like Polt Group to construct properties specifically for their rental portfolio. They're not buying existing homes, they're commissioning new ones that will never be available for you to purchase. By the time you're browsing listings, the best inventory is already gone. If you're a first-time buyer, you might be using an FHA loan, lower down payment, more accessible for people without huge savings. But FHA paperwork is slow. It often gets delayed. Sellers know this, and they avoid FHA buyers even when the offer is competitive. Lori Goodman, housing finance expert at the Urban Institute, put it plainly, FHA buyers have a particularly tough time competing against Wall Street firms. The process is clunky, and sellers don't want to wait. Institutional investors exploit this. They know you're at a disadvantage, and they know sellers will take their offer over yours, even if yours is higher, because theirs is simpler. Here's the uncomfortable truth. Institutional investors aren't buying homes to live in. They're buying cash flow. They run models on rent-to-price ratios, projected appreciation, property tax rates, HOA fees. If the numbers work, even at a price that seems high to you, they buy. You're thinking, can I afford this monthly payment? Will I be happy here? They're thinking, what's the IRR over 10 years? How does this fit in the securitized rental bond we're selling to investors? It's not that they're overpaying recklessly. It's that they're optimizing for different metrics. They can afford to pay more because they're playing a volume game across thousands of properties. You hire a plumber when the sink breaks. It costs $200. Invitation Homes has regional maintenance teams on staff. They negotiate bulk contracts with suppliers. Their per-unit repair costs are lower because they're servicing thousands of homes. You pay market rate for property insurance. They get discounted premiums because they're insuring massive portfolios. You pay a property manager 10% of rent if you're a landlord. They have in-house systems and software managing everything centrally. The bigger they get, the cheaper each home is to operate. That's an advantage you, as an individual buyer or small landlord, will never have. Here's where it gets wild. Institutional investors don't just rent homes, they package the rental income into bonds and sell them to investors. In 2013, Invitation Homes created a new asset class, single-family rental securities. They bundle thousands of rental properties, slice up the cash flow, and sell bonds backed by your rent payments. Reuters analyzed one of these securities, 7,024 homes, generating an average $1,538 a month in rent, plus $985 a year in fees. Investors buying these bonds get a cut of that income. This matters because it means institutional landlords have access to cheap capital that you don't. They can borrow money at lower rates than you, use it to buy more homes, package those into more bonds, and repeat. It's a flywheel. The more homes they own, the easier it is to raise money to buy more homes. And once they own the properties, they don't just set rent at market rate, they optimize. Some firms use revenue management software, similar to airline pricing, to maximize rent based on demand, vacancy rates, and competitor pricing. They're also accused of using RealPage and similar platforms that allegedly allow landlords to share rental pricing data, which critics say leads to coordinated rent increases. The DOJ has actually filed antitrust lawsuits over this. Whether it's illegal collusion or just aggressive pricing strategy, the result is the same. Rents go up faster than they would with fragmented mom-and-pop ownership. If you're trying to buy a starter home in Atlanta, Phoenix, Charlotte, Tampa, or Dallas, you're not just competing with other families. You're competing with firms that have billions in cash, buy before listings go public. Close faster than you can get a loan approved. Don't care if they overpay by $10K because it pencils over 10 years. Can outbid you even when your offer is higher. Because sellers prefer certainty. It's not a fair fight, and it's making homeownership harder for the generation that should be buying their first homes right now. But here's the question. No one's asking what happens to the neighborhoods after Wall Street takes over, the tenant experience, the eviction rates, the maintenance quality. There's data on all of this, and some of it is pretty damning. Let me show you. Invitation Homes will tell you they're providing a valuable service. Professional management, quality homes, responsive maintenance. They point to customer satisfaction scores, 4.5 out of 5 according to their data. But talk to tenants, read the lawsuits, dig into the research, and a different picture emerges. A 2016 Federal Reserve Bank of Atlanta study found that institutional landlords like Invitation Homes evict tenants significantly more often than small mom-and-pop landlords. Why? Because their business model is optimized for cash flow, not relationships. A small landlord might work with you if you're late on rent. They know you, they know your situation, they have flexibility. A corporate landlord has policies, quotas, and bondholder obligations. Your tenant 47,293 in a spreadsheet. If the rent's late, the eviction process starts automatically. Academic research in Atlanta showed that in neighborhoods where institutional investors acquired 5 or more properties, eviction rates increased by 4.4%. That's not coincidence, that's business strategy. Georgia Senator Raphael Warnock said it bluntly. Private equity poses a real problem. Home to them is just a row on a spreadsheet tracking shareholder returns. In September 2024, Invitation Homes reached a settlement with the Federal Trade Commission. The FTC accused them of saddling tenants with hidden fees, unjustly withholding security deposits, misleading tenants about eviction policies during the pandemic. Invitation Homes agreed to refund $48 million to harmed customers. Reuters found one bond backed by 7,024 Invitation Homes properties where tenants were paying an average of $985 per year in fees on top of rent. Junk fees for things like amenity access in neighborhoods with no amenities, lease renewal fees, monthly technology fees for using an online portal. These fees don't exist with most small landlords, but they're pure profit for institutional operators, and they get baked into the securities sold to investors. Bond data analyzed by Reuters showed Invitation Homes spent an average of $1,142 per year on maintenance per property. Compare that to the typical homeowner, who spends around $300 annually on home maintenance and repairs. Why the gap? Because institutional landlords are incentivized to minimize costs. Every dollar saved on repairs is a dollar that flows to bondholders. 5 former Invitation Homes employees interviewed by Reuters said the company consistently spent too little on maintenance. Repairs were delayed, complaints were ignored, work quality was subpar because they used the cheapest contractors. Invitation Homes disputed this, saying bond data didn't account for all expenditures, but tenants tell a different story. One pattern that keeps appearing in tenant reviews: responsiveness for small cosmetic issues, but delayed or inadequate responses for major problems, foundation issues, mold, HVAC failures. It makes sense from a business perspective. Fix the cheap stuff fast to avoid bad reviews. Delay the expensive stuff as long as legally possible. When institutional investors started buying homes at scale, some economists argued it would actually help affordability. More rental supply would push rents down, right? Wrong. Invitation Homes explicitly tells investors the opposite. From their pitch materials, we operate in markets with strong demand drivers, high barriers to entry, and high rent growth potential. Translation: they target cities where housing supply is constrained and rents are likely to keep rising. They're not flooding the market with affordable rentals. They're cornering supply in undersupplied markets and extracting maximum rent. MIT researcher Maya Abood analyzed 4 LA neighborhoods where Invitation Homes owns rentals. In some areas, they controlled 10% to 25% of rental housing in the neighborhood. When one landlord has that much concentration, they have pricing power. They're not a price taker, they're a price setter. Remember those rental bonds? Here's why they matter for tenants. When Invitation Homes packages properties into securities, they're selling a promise to bondholders. Steady rental income, increasing rents, low vacancy rates. That creates pressure. To keep bondholders happy, the company needs to keep occupancy high, evict slow payers quickly, keep rents rising, annual increases regardless of tenant hardship, keep costs low, minimal maintenance spending. Kevin Stein from California Reinvestment Coalition called it the securitization of rental income, turning housing into a financial product where tenant welfare is secondary to investor returns. You're not just renting from a landlord, you're a cash flow stream in a bond prospectus. What happens when institutional investors own 20 to 25% of a neighborhood's rental housing? Researchers have found mixed effects. Positive: some evidence suggests property crime decreases slightly in neighborhoods with institutional ownership, possibly because properties are better maintained and monitored. Negative: tenant turnover increases, community stability decreases, long-term residents get displaced when they can't keep up with rent increases. In gentrifying areas, institutional investors accelerate displacement. They buy lower-priced properties, renovate minimally, and raise rents to market rate, which prices out existing tenants. The neighborhood changes, but not necessarily for people who already live there. This hasn't gone unnoticed. In 2025, President Trump proposed banning large institutional investors from buying single-family homes. The announcement tanked shares of Invitation Homes, American Homes 4 Rent, and Blackstone. Democratic lawmakers have introduced similar bills. Red states like Florida and Texas, not exactly anti-business, have debated restricting institutional purchases because constituents are pissed about being outbid by Wall Street. Blackstone's stock dropped to a one-month low when Trump's comments went public. American Homes 4 Rent hit a 3-year low. The market clearly sees political risk. Whether anything actually gets legislated is another question, but the backlash is real. Banning institutional investors won't solve the housing crisis. Because the real problem isn't that Wall Street is buying homes. The real problem is that we're not building enough homes. Institutional investors target markets with housing shortages. If cities like Atlanta, Phoenix, and Charlotte were building enough housing to meet demand, investors wouldn't be able to extract these returns. Rents wouldn't spike. Prices wouldn't climb as fast. As UCLA professor Michael Manville put it, institutional investors like to buy in the Bay Area because the Bay Area doesn't build housing. These companies feed off scarcity. You could ban every institutional buyer tomorrow, and prices would still be high, because supply is constrained. The institutional investors are a symptom, not the cause. But they're also making the problem worse by consolidating supply and extracting maximum value from scarcity. So where does this go from here? Are institutional investors pulling back, doubling down, or evolving into something new? And what does that mean for anyone trying to buy a home in 2026? That's the final piece. Here's something interesting. Institutional investors aren't buying as aggressively as they were during the pandemic boom. In Q1 2023, Invitation Homes sold 297 homes and only bought 194, making them a net seller for the first time in years. American Homes 4 Rent, same story. Sold 666 homes, bought 312. According to John Burns' research, institutional investors bought 90% fewer homes in early 2023 compared to early 2022. Why the pullback? Simple. The math doesn't work anymore. During the pandemic, interest rates were near zero, home prices were rising fast, and rents were spiking. Institutional investors could borrow cheaply, buy homes, and immediately generate positive cash flow. Now, mortgage rates are 7 to 8% for the floating rate loans these firms use. Home prices are still elevated, rent growth has slowed. The returns on buying additional properties just aren't there. Tejas Joshi, director at Yield Street, which owns 700 plus homes, said his firm didn't buy a single home in Q1 2023. High interest rates coupled with frothy home prices mean buying new rentals doesn't make sense right now. So institutional investors are net sellers in many markets. Does that mean the problem is solving itself? Not quite. While they're not buying as many homes from regular sellers, they're buying from each other. In 2025, Blackstone acquired Tricon Residential's 38,000 homes for $3.5 billion. That's not new institutional ownership, it's consolidation. Homes that were already rentals just change corporate hands. Invitation Homes bought 900 homes from Starwood in 2023. Again, consolidation, not expansion. What's happening is the big players are getting bigger by absorbing smaller institutional portfolios. The total number of institutionally owned homes isn't growing much, but ownership is concentrating in fewer hands. Invitation Homes, American Homes, 4 Rent, and Blackstone now control the vast majority of large-scale single-family rentals. That's arguably worse than fragmented ownership, because it increases pricing power and reduces competition. Here's where it gets interesting. Institutional investors are pivoting from buying existing homes to building new ones specifically for rent. Invitation Homes has partnerships with home builders to construct properties that will never be sold to individuals. They're built to rent from day one. This is actually less problematic than buying existing inventory because it adds housing supply rather than removing it from the for-sale market. But it also cements the trend toward permanent renter class. These aren't homes you can buy later. They're designed as rentals forever. If you're trying to buy a home right now, here's the landscape. Good news. Institutional investors aren't bidding as aggressively as they were in 2021-2022. They've pulled back in many markets. Bad news, home prices are still high, mortgage rates are still elevated, and inventory is still tight. The institutional pullback hasn't translated into affordability for regular buyers yet. The real issue, supply. Until cities approve more construction, ease zoning restrictions, and actually build housing at scale, affordability won't improve, regardless of what institutional investors do. If you're house hunting, be aware of where institutional concentration is highest. Highest institutional ownership, Atlanta, 25% of rentals. Phoenix, 20%. Charlotte, 22%. Tampa, 18%. Jacksonville, 21%, Dallas, Las Vegas, Orlando. In these cities, you're more likely to compete with institutional cash offers, face higher rents, and see neighborhoods shift toward corporate ownership. Lower institutional presence, cities with stable, declining populations, Pittsburgh, Providence, Cleveland, expensive coastal markets where returns don't pencil, SF, NYC, Boston, markets with strong construction pipelines adding supply. If we want housing to be accessible, here's what has to happen. 1. Build more housing. This is 80% of the solution. Restrictive zoning, NIMBYism, and slow permit processes are choking supply. Cities need to approve more construction, period. Institutional investors exploit scarcity. Eliminate scarcity, you eliminate their advantage. 2. Level the playing field FHA loan reforms to speed up processing. Rehab loan programs that are actually usable for first-time buyers competing for fixer-uppers. Tax advantages for primary residence buyers versus institutional investors. 3. Transparency requirements. Require disclosure of institutional ownership levels by neighborhood. Mandate reporting on eviction rates, maintenance spending, fee structures. Shine light on the practices. 4. Anti-concentration measures. Some cities have discussed caps on institutional ownership in specific neighborhoods. If one entity owns more than X% of rental housing, they can't buy more. Controversial, but worth debating. 5. Tenant protections. If institutional landlords are going to own large chunks of rental housing, there need to be stronger protections. Caps on junk fees, faster maintenance response requirements, restrictions on rent increases, eviction reform. Even if every reform passed tomorrow, housing would still be expensive, because we've underbuilt for decades. The US is short millions of housing units. That deficit didn't happen overnight, and it won't get fixed overnight. Institutional investors didn't create the housing shortage, but they're profiting from it, and their presence makes it harder for first-time buyers to compete. Wall Street didn't cause the housing crisis, but they saw an opportunity in it. After 2008, firms like Blackstone pioneered a new model: buy foreclosed homes at scale, rent them out, package the rental income into bonds, and sell those bonds to investors. It worked. They made billions. Now, over 500,000 single-family homes are owned by institutional investors. In some cities, it's 1 in 4 rentals. These firms have structural advantages you can't match: all-cash offers, algorithmic targeting, economies of scale, access to cheap capital. If you're trying to buy a starter home in Atlanta, Phoenix, Charlotte, or Tampa, you're not competing on a level playing field. You're competing against billion-dollar portfolios optimized for cash flow. If you're renting from an institutional landlord, you're probably paying more in rent and fees than you would with a small landlord. Maintenance might be slower, eviction risk is higher. If you're trying to buy, you're facing tougher competition and higher prices because investor demand is removing inventory from the market. If you're worried about your kids being able to afford homes, this trend doesn't help. But here's what I want you to understand. The real villain is not Blackstone or Invitation Homes. The real villain is housing scarcity. Institutional investors feed off undersupply. If cities built enough housing, their business model wouldn't work. Rents wouldn't spike. Prices wouldn't climb as fast. Blaming Wall Street is emotionally satisfying, but it misses the point. The solution is building more homes, a lot more, and making it easier for regular people to compete. What you can do: 1. Show up to local zoning meetings. The biggest barrier to affordable housing is local opposition to construction. Be the voice supporting more housing. 2. Ask your representatives about housing policy. Push for FHA reform, tenant protections, and construction incentives. 3. If you're renting from an institutional landlord, know your rights. Document everything. Join tenant advocacy groups. 4. Spread the word. Most people don't know this is happening. Share this. Talk about it. What I want to hear from you: drop a comment. Are you competing with investors in your market? Have you rented from Invitation Homes or another institutional landlord? What was your experience? Do you think banning institutional buyers would help, or would it not matter without more supply? What's your city doing or not doing about housing? I want real stories, because this isn't just data, it's people's lives.